Hi there everyone, this is Kate A. Samako, the first reporter of Blue4, and let's talk about the foreign exchange market. So, in order to understand Forex, let us first dive in where it all started. So, one of the most significant events in history that helped to standardize the Forex market as we have today is the Bretton Woods system. Here, 44 countries reached an agreement to establish the International Monetary Fund and the World Bank. The Bretton Woods Agreement also called for a system of fixed exchange rates that would be administered by the IMF. What do we mean by this fixed exchange rate system? So this is also known as a peg exchange rate. It is basically where participating countries peg their currencies to the US dollar, and only the dollar itself was pegged and convertible into gold at a fixed rate. Also, under this system, countries could also adjust their exchange rates, either into two ways. So the first one is through devaluation, and the second one is through revaluation. And apparently, this system began to show signs of strain and eventually collapsed in 1973. And since then, we have had a managed float system. So what is this floating rate system? So this refers to a currency where price is determined by supply and demand. Its exchange rates are determined by the foreign exchange market, reflecting economic conditions, geopolitical events, and investor sentiment. Also, government and central banks may still occasionally influence their currency's value, but the primary driver is still the interaction of market participants. And next, we finally have here the foreign currency exchange market, or we can also call as Forex or FX. So what is FX? What is the meaning of FX? So FX is a decentralized global marketplace where participants can buy, sell, exchange, and speculate on currencies. This operates 24 hours a day and 5 days a week, which the overlapping period allows the participants engaged in the market, such as the central banks, individual traders, and others, to contribute much to the market's liquidity and influences exchange rates. And because of this, it contributed much to the market as being one of the largest, most liquid market in the world. And now, we have here the exchange rate. So to define this is simply the price of one country's currency expressed in another country's currency. So why are they important? This is important as they affect the relative price of domestic and foreign goods. So as you can see, when a country's currency appreciates, domestic sellers in this situation will find it harder to sell the goods abroad and can increase competition at home for foreign goods because they cost less. Meanwhile, when it depreciates, goods abroad become appealingly cheaper and foreign goods the opposite. And this is the updated reference of the exchange rate bulletin by the Bangko Sentral ng Pilipinas.
Next topic is about the foreign currency exchange rate transaction. So there are two kinds of foreign exchange rate transaction. First is the spot transaction and second is the forward transaction. Spot transaction are those which involve immediate exchange of bank deposits. The spot exchange rate is the exchange rate for the spot transaction. Example for the spot transaction. Imagine you walk into a grocery store and buy a basket of apples by paying with cash. The moment you hand over the money and receive the apples, that's a spot transaction. The goods are exchanged for payment immediately. Second is the forward transaction. Forward transaction involve the exchange of bank deposits at some specified future date. The forward exchange rate is exchange rate for the forward transaction. An example of a forward transaction is, let's say, you agree with a farmer today to buy a bushel of apples from their next harvest at a specified price. The actual exchange and delivery of apples along the payment will occur at a later date. This is an example of a forward transaction. Next is the spot exchange rate. The spot rate for a currency is the exchange rate at which the currency is traded for immediate delivery. Example for a spot exchange rate is if you exchange 100 US dollars for 85 euros at a currency exchange desk in a shopping mall, and this exchange happens immediately. Based on the current market rate, that is a exchange rate transaction. So the direct and indirect quotes. A direct quote indicates the number of units of the home currency required to buy 1 unit of the foreign currency, while indirect quote indicates the number of units of foreign currency that can be bought for 1 unit of the home currency. And to compute the indirect quotes, from the Philippines direct quotes of spot rate for US dollars, UK pound, euros, Japanese yen as of August 27, 2019. First is to Identify the direct quote if the direct quote is, for example, USD equals 0.85, meaning 1 USD is equivalent to 0.85 euro. Second step is to invert the rate. To get the indirect quote, you invert the rate. In this case, it becomes USD equals 1, which is approximately 1.18. So, an indirect quote of USD equals 1.18 means 1 euro can be exchanged for $1. Cross rate is the indirect computation of the exchange rate of one currency from the exchange rates of two other currencies. Arbitrage is the simultaneous purchase and sale of the same or similar asset in different markets in order to profit from the tiny differences in the assets of listed price.
So we have here the second foreign currency exchange rate transaction, which is the forward market transaction. It is the trading of currencies for future delivery. It has forward rates, which is an interest rate applicable to a financial transaction that will take place in the future. And we call it forward premium when forward rates may be greater than the current spot rate, and discount when it is less than the current spot rate. So there are factors that affect exchange in the long run. These are the relative price level, trade barriers, preferences for domestic versus foreign goods, and productivity. So if we have the effect of exchange in the long run, we also have factors that affect exchange rates in the short run. It refers to the price of one currency in terms of another over a short period. It can be affected by various factors including interest rates, inflation, and political stability, among others. So, in this foreign currency exchange rate transactions, we have risks. So, it refers to the losses that an international financial transaction may incur due to the currency fluctuations. They can also affect investors who trade in international markets and businesses engage in the import and export of products or services to multiple countries. So there are three types of foreign exchange risk. These are the transaction risk, translation, and economic risk. So an exchange rate risk is the possibility of losing money due to changes in the value of one currency relative to another. So there are different ways to avoid or reduce the risk depending on your situation and goals. So first is the firm may hedge its risk by purchasing or selling forward exchange contracts. Second is the firm may choose to minimize receivables and liabilities denominated in foreign currencies. Third is maintain a monetary balance between receivables and payables denominated in a particular foreign currency to avoid a net receivable or net liability position in that currency. So fourth is the use of trigger pricing. Fifth is diversification. And lastly, last but not the least, a speculative forward contract does not hedge any exposure to foreign currency. It creates the exposure. So that's that.
Factors influencing exchange rates. As with any other market, the exchange rate between two currencies is determined by the supply of the demand for those currencies. The present international monetary system consists of a mixture of a freely floating exchange rate and fixed rates. The factors that tend to increase the supply or decrease the demand schedule for a given currencies will bring down the value of that currency in foreign exchange market. Same goes to the factors that tend to decrease the supply or increase the demand for currency. It will raise the value of that currency. Although the value of currency is determined by the aggregate supply and demand for that currency, this alone does not help financial managers understand or predict the changes in exchange rates. These are the 5 major reasons for exchange rate movements. 1. Inflation. Inflation tends to deflate the value of a currency because holding the currency will only result in reduced purchasing power. 2. Interest rates. If interest result in a particular country are higher relative to other countries, individual and companies, it will be enticed to invest in that country. And as a result, there will be an increased demand for the country's currency. 3. Balance of payment. Balance of payment is used to refer to a system of accounts that catalogs the flow of goods between the residents of two countries. For instance, if Philippines is a net exporter of goods and therefore has a surplus balance of trade, countries purchasing the goods must use the country's currency. This increases the demand for the currency and its relative value. 4. Government intervention. Through intervention, like buying or selling the currency in the foreign exchange rate, the central bank of a country may support or depress the value of its currency. Lastly, other factors that may affect exchange rates are political and economic stability, extended stock market rallies, and significant declines in the demand for major exports. How is foreign exchange traded? You cannot go to a centralized location to watch exchange rates being determined. Currencies are not traded on exchange such as the New York Stock Exchange. Instead, the foreign exchange market is organized as an over-the-counter market in which several hundred dealers, mostly banks, stand ready to buy and sell deposit denominated in foreign currency. Because these dealers are in the constant telephone and computer contact, the market competitive, in fact, it functions no differently from a centralized market. Interaction in foreign currency markets. Exchange rate determination. Equilibrium exchange rate in floating markets are determined by the supply of and demand for the currency. As the graph shown above, the equilibrium rate of PE will prevail in the market. No surplus or deficit occurs at PE. Fixed exchange rate. An exchange rate set too high in foreign currency unit per peso. It tends to create a deficit Philippines balance of payments. This deficit must be financed by drawing down foreign reserves or by borrowing from the central banks of the foreign countries. This effect is short-term because at some time, the country will deplete its foreign reserves. Major reasons for country devaluation is to improve its balance of payments. Many developing countries use currency exchange rationing to avoid a deficit balance of payment.